This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 229 was pre-recorded back on July 7th, 2020. I'm Erik Townsend. This episode is brought to you by TopTradersUnplugged.com, a podcast dedicated to quant and rules-based investing, helping investors overcome behavioral biases. For this week's holiday special, we're going to deviate from our usual show format. We're not going to have a market wrap or a post-game interview, and instead, we're going to do a double-length interview. And of course, to pull off a double-length interview, you need a rock star guest. So we've got Grant Williams, one of our favorite people in the industry, joining Patrick and me for a double-length feature interview.
Thanks for having me. It's always good to chat with you guys.
Grant, it's great to have you back. I have to say I am disappointed, though, because you and I both have been kind of ridiculed by a lot of people in the finance industry for being too negative. We both predicted a lot of negative things years ago. We thought that civil unrest would increase. We thought that there would be more Fed balance sheet expansion so that gold would eventually look like the only really sure investment on the table. And we were called all sorts of names, naysayers and perma bears and so forth. I was kind of hoping that we would both be proven wrong by now. And unfortunately, the opposite seems to be happening. So what do we make of this current environment where it seems like, it feels to me like the fourth turning is kicking into high gear. And unfortunately, what concerns me the most, Grant, is if I follow Neil Howe's work, really we should expect about 8 more years of this before the fourth turning gets into its final phase and we start to see some resolution. And if this is just the beginning, boy, we could be in for a rough ride.
Yeah, it's a scary thought, isn't it? I mean, look, you and I had this conversation, I guess back in maybe January, I think we last chatted, and we talked about the civil unrest. I'd just written about it, and you've been talking about it again. And yeah, I think it's one of those things that we both hope to be wrong. And it's funny, people, when you talk about these things, the whole idea is to talk about ideas, right? And talk about potential outcomes and then handicap them and decide whether you need a plan to deal with them or not. And yet, when you talk about these things, people see them in absolute terms. They assume that you're a crackpot, and that they want you to put a timeline on. Hey, so when is society going to dissolve? And there's never an answer to that thing. It's really all about understanding the mood, understanding the kind of forces pulling at that societal fabric, and working out whether it's a real threat. And clearly, as we've gone through the last 12 months, it's become obvious to a lot more people that this is a real threat to society. It's a threat to capitalism. It's a threat to Western democracy. And it's a very real threat that people need to think about and potentially have a plan to deal with it. I mean, you've seen the physical violence in the streets. You've seen that polarization that you and I spent a lot of time discussing last time. In every corner of our everyday lives become more physical and more easy to see and be represented in conflict of the sort of physical kind, as opposed to just the verbal conflict that you see in the media or on social media these days. So it's a real problem, Erik. And when you talk about Neil's work in the fourth turning, and we have 8 more years of this, I think it's if you had gone back to the days before the fall of the Roman Empire, you would have had the same mindset. People would have not been able to conceive of the end of the Roman Empire because it had been this extraordinary force for everybody's lifetime. No one really remembered a world without it. And these big shift changes are very difficult for we as human beings to get our heads around, because it upends everything you think of as normal, and we're just not used to that. So just having the ability to consider these extreme outcomes is very, very important. If you're going to invest, you have to be able to conceive of the inconceivable. And that's what a change of empire really is. And it's really happened quite quickly in this last 12 months. I think if you hadn't been paying attention, you hadn't been recognizing that it was a threat, then seeing the looting and the rioting, not just in the US after the tragic death of George Floyd, but the sort of kind of sympathy stuff around the world has come as a great shock. And social media was littered with people who were distraught about what they were seeing. But I think for anyone that's had their eyes open for a while, this was unfortunately a very natural evolution of where we're going to get to, and we're there.
What concerns me about this, Grant, is I don't see any reason to think that this is winding down or ending. I see the opposite. If I really step back, it appears to me, if you think about how a civil war gets started, now certainly it's probably early to make the prediction that that's for sure what this is. But look, everything that we're seeing is exactly consistent with the way that civil wars begin. So I guess my question to you is, what does history teach us? If you're at a point where the present circumstances around you are consistent with the way that civil wars start, but of course, that's not the only possible outcome. What are the things that we should be watching for, both in society and as investors, to tell us how it's going, whether it's going to escalate into something as big as a civil war or if it's going to die down and be forgotten?
Well, right now it's a relatively civil war, right, with a lowercase c. I mean, it's verbal, it's ratcheting up, but we're not seeing the kind of state on state stuff which I think you would certainly need to see. I mean, there are some touches of it around the edges, but at the moment, what we really have in society, if you read the media, is a left-right divide, and that is not so much of a problem because if you do things down the middle, then you capture every strata of society on both sides. What this really is, and what it's, I suspect, going to morph into, is a rich-poor divide. And that's a lot more problematic because once you start to put the line horizontally, then you have on one side the people with power and money and possessions and assets, the haves, and on the other side, you have the people who are angry and upset and the have-nots, who don't have assets, who don't have great incomes, who are dependent upon the state. And that's a much more problematic divide to have because, there's a lot of anger in that. And that's why it's incredibly unfortunate what has been happening in terms of the Federal Reserve and the policies they pursued because, I know Jay Powell in his press conference says that he doesn't see any direct line between Fed policy and inequality, but it's total nonsense. I mean, it's total nonsense. Everything the Fed's done has exacerbated this. It's made those who hold assets filthy rich, and those who don't are struggling to keep up. And I think what we've seen recently with this PPP program, with the companies being announced, you can understand why Mnuchin was desperate not to release these names, because since they were released a couple of days ago, people are still going through the list, and what they're finding are extraordinary abuses of the program by people who really should be leaving that money to mom and pop stores. Now, people will say, well, my accountant does all that for me and he just went and did it as a matter of course, but that's not really the point, is it? So I think what worries me is that the dividing lines, as I said, is horizontal as opposed to vertical. And if you've got people with nothing who are desperate, they know where the people with something live, they know what they want, and they've got nothing to lose. And it becomes incredibly problematic, potentially very, very quickly. So I do worry about it, Erik. I really do. It's something that I spend a lot of time thinking about. It's not doom-mongering. It's not fear-mongering. It's a real possibility. People have to accept that it is a real possibility now. It's not a coin toss by any means, but it's not zero, and it's not 1 or 2% anymore. It's edging higher with every round. And I suspect the upcoming election could be a very polarizing event. My fear is that Trump loses the popular vote again, but wins the Electoral College. I think if that happens, which we've seen is a very easy thing to happen. If that happens, I think we could see some real fireworks, and it troubles me greatly.
Well, once again, we're thinking almost exactly on the same lines. My feeling for months and months has been what we're actually seeing right now is a societal divide between the haves and have-nots, which is being misinterpreted by the masses because, of course, people, in these circumstances get emotional and so forth. It's being misinterpreted as this left-right thing, as this racial thing. And, of course, those are real issues. I don't mean to dismiss that there are real issues with racism in the United States. But I think the real divide is being driven by the haves versus the have-nots. And here's what I find most interesting about it. I can say this for myself, but also for a whole lot of our guests that I've interviewed on MacroVoices. You know, I'm one of the haves. You'd think that if the circumstances that are being created are to my benefit, if I'm one of the guys who's making money in financial markets while people on Main Street are not getting the help that they need to feed their families, you'd think I'd be one of the guys arguing in favor of that. But I find this to be absolutely just a ridiculous abandonment of what capitalism is supposed to mean. The capitalism I believe in is the one where anybody, no matter what you have, what you start with, can start with nothing, work really hard, start their own business, and become one of the haves. And we don't have that anymore. We had it when I was a kid. We don't have that anymore. We now have these policies which do benefit me. They benefit you. They benefit a lot of the guests that I've interviewed on MacroVoices. But what I find interesting is people like you and I and a lot of our expert guests are absolutely disgusted by these policies which actually benefit us personally, financially. Is there any precedent in history to where that's been the case? It seems kind of backwards.
Well, look, there's always precedent. That's the beauty of history. Everything has happened before. Ecclesiastes said there's nothing new under the sun 3,000 or 4,000 years ago. So it's not a question of that. But I think you're right. I think what's interesting is that there within the haves, there are different classes, and the uber wealthy, they own a lot of assets. They have an extraordinary share of the wealth of the United States, and I'll just use that country because I've looked at the data. They have an extraordinary percentage of the income. But then when you get into the haves at the lower end of the haves, it's not so clear cut, right? It's not. There are a lot of people who earn what you would think of would be a good salary, but by the time they've paid tuition for their kids and by the time they've paid for a house and stuff, it doesn't give them the kind of life that the people that don't earn that kind of money imagine it does. Now, they're obviously much better off, but it's a problem because being rich has also been stratified. There is rich, there is oligarch rich, there is Bezos rich, and there is well off. And as the haves and the have-nots are separating, the rich are separating from the well off as well. And it just increases that divide. It just makes it more problematic. And look, the answer is not to make everything fair, because life isn't like that, right? Life isn't fair. And this is one of the big problems. I've got two young girls and well, not young anymore, but when they were kids, I would, anytime either of them came to me and said, "Dad, it's not fair," I would also say, "Look, it's not. Life isn't always fair. You have to get used to that idea." But we can do a much better job of trying to level the playing field as and where we can. And it starts with things like this PPP program, where there's clearly been little to no oversight, and the people with the expensive accountants have known how to game the system, as always happens. And it's incentives. If you start punishing people for taking advantage of this, if you start putting rules in place to shut out the people, the Starbucks and I forget some of the other, I think Chipotle took a big, Shake Shack took a big chunk of this money. There were a lot of big corporations that took it, were shamed in the press and then gave it back. But we all know what would happen if they hadn't been outed. But of course, this was rushed like everything is, and I understand the urgency, but there have to be punishments. And this idea of the wealthy class being punished for transgression is rife in everything we look at. I mean, and you only have to look at the stock market for that. You only have to look at our favorite Elon Musk, right, and the way he's been handled by the SEC, including his most recent acronym tweet, which for those of you that haven't seen it, you just go and look it up. For someone to be behaving that way in public with a platform like he has to regulators who are supposed to be making sure that he embodies everything it is to be the CEO of a business is shameful. And that's where we've reached. There is no respect for authority. There is no respect amongst the wealthy, because it's been proven time and time again that if you have the money, if you have the assets, if you are rich and powerful, you can just about get away with anything. And so, again, we come back to that fear that the people who are going to impose penalties upon these people are going to be the have-nots. And those penalties are not going to be a few months in a white-collar prison. Those penalties are going to be much more violent than that. And if you're paying attention, you can feel this building. It's very uncomfortable. it's a very real threat. And unless changes are made, unless things are done to try and stop this, which unfortunately requires an acknowledgement on the part of the people in a place to do something about it, who are, generally speaking, amongst that top 1%, unless they start to police themselves, this, I suspect, is going to end very, very badly, Eric, just as you have predicted.
Grant, you said just a couple of minutes ago that the mechanism that has really propelled for the last decade, the haves advancing their position over the have-nots, has been what we call money printing, although technically it's creation of base money in the money supply, which is not technically money printing, but it's pretty darn close to it. It seems to me that we're very close to a moment that I've been predicting for several years, which is where Main Street, the have-nots, collectively figure out, probably through their political leaders, wait a minute, this magic printing press that the federal government has, that a whole bunch of people said was going to lead to massive inflation if it was abused, didn't lead to massive inflation. And furthermore, that money that gets printed doesn't have to be used to prop up asset markets to make rich people richer. It could be given to us. And, of course, the MMT movement is gaining a lot of traction in certain political circles. They might be the people to bring these ideas forth in the political realm. How close do you think we are to a moment where maybe the tables get changed? And I would predict that we move not to less money printing, but to a whole lot more of it. But it's with a very different intended outcome, and it's with different people in charge of the process. Am I right to think that might be coming, and how far off do you think it might be?
Well, look, it's once you've started handing this kind of stuff out, good luck trying to take it away. We knew that going in, and that's become clear. And again, this comes down to Charlie Munger's old saw about show me the incentives and I'll show you the outcome. And if you look at this already, we're not very far into this experiment. And what you've seen so far are the checks that have been mailed, the stimulus checks under the CARES Act that have been mailed to people. $1,200 a week. If you've got kids, you get more. $600 a week to people to basically substitute their income. And funny enough, over the last couple of weeks, I've spoken to several people who run businesses who can't get their staff to come back to work because they're making more money sitting at home than they were working prior. And so if you do these kinds of things, if you start down this road, human beings are the same. We don't change. We never have over time. And if you offer someone more money or even a similar amount of money to do nothing, they're going to take that at the margin. The marginal worker is going to take that deal every time. And so once you've started down that path, you better keep those payments up because then you have problems. And obviously we're in an election year now and it's going to be a bitterly contested election. So when you talk about the Fed's balance sheet, I think you're absolutely right. I think we could be at 10 trillion by the end of the year easily. I mean, it's kind of wound down a little bit over the last couple of weeks. We've seen the first kind of gentle slide in the size of the Fed's balance sheet. And it's going to be interesting to see if the markets can hold up because every data point you look at would suggest that it really is reliant wholly on the Fed's largesse to keep the markets going. The correlation between the charts is amazing. So if they do start to wind that back in, it's going to be very interesting to see what the market makes of a gradual decline in liquidity given how overstretched valuations are. But to get back to your question, this idea of MMT, I mean, we're basically there in essence, and seemingly nothing bad has happened. The next test, obviously, is going to be seeing some data improve and having the administration, whether it's Mnuchin or Trump himself, lauding all this fantastic data about the jobs being created, which obviously aren't being created. They're just people going back to work. But they've made a lot about spinning this stuff. And if you do have this strong recovery, it makes it much harder to dole out more money when a lot of these payments start rolling off at the end of this month. So we're in that sweet spot at the moment where the stimulus checks are still going out. The market's doing well. The economy is recovering, although recovering is different to being back to where you were. And somewhere, something's going to have to shift. Either we are going to see valuations reflect an economy that, while it's recovering, shows no signs of getting anywhere near where it was for some considerable time. And if you look at the forecast from the likes of the IMF and even the Fed now, they're pushing back their forecast of recovery. They're increasing the size of the fall in GDP for this last quarter. So the headline numbers look to be getting worse. as the stimulus checks roll off and support for the market dwindles, and the Fed and the government are going to be tested in the next 2 or 3 weeks, I suspect, very seriously. And I would bet a pound to a penny that they are going to stick their hands back in the taxpayer's pocket and they are going to start throwing enormous amounts of money around again, because now, as I said, they've started down that road. It's very difficult to look your kid in the eye after handing them a candy and say no more. But that's really what they're going to have to do. And they're going to have to take the time to figure out, okay, how do we target the next round of stimulus so that it doesn't go to Starbucks and it doesn't go to Chipotle and it doesn't go to Santa Monica-based registered investment advisors and it doesn't go to hedge funds, which is what's been happening. And that requires some thought and it requires some heavy punishments being put in place. But everything feels as though it's seat of the pants time, and there's no real thought going into this. They're fighting the last war, and they're desperate to keep the wheels on this thing, and that's a really poor way to go into this, unfortunately. But it's what we have.
Now, what the critics of central bank balance sheet expansion said all the way back in 2009 was they said, but you've got to be awfully careful because, boy, if you let this go on too long, what happens is you eventually blow up the entire system, the dollar crashes completely, and you end up with runaway hyperinflation. One thing that seems to be just resoundingly clear, Grant, is although those may be bona fide concerns, almost everybody was early in thinking that there could be runaway inflation because of central bank balance sheet expansion. Well, we have seen runaway inflation of asset markets, but certainly not consumer price inflation. So how long could this go on? How much more money printing and central bank balance sheet expansion is possible before the system really does blow up?
Well, I mean, a couple of things. First, the answer to the question when is unknowable because it's the future. So we don't know, right? And as you pointed out quite rightly, a lot of people thought this would have happened a decade ago, but it hasn't. So we don't know when, and we don't know how the system's going to blow up. But the problem comes with the fact that because things are so extreme that when the blow up happens, and it will happen, there will be a blow up. It's what happens at that point, because the policies that are now in place to basically maintain the status quo are the exact same policies that were used in an emergency to try and repair the damage. So if they're really just a Band-Aid now to keep the thing together, you have to come up with something way more dramatic and extremist. And that's, by definition, we are heading to an extreme outcome one way or the other. It's coming because just looking at what's happening, I think we all understand that this can't go on forever. We all understand that the economy can't take the kind of hit it's taken. We can't keep states closed. We can't open them and reclose them again. It just doesn't work. And none of this stuff works. And it doesn't work to fund that by creating liquidity out of thin air. And I think you mentioned a little while ago that maybe Main Street is starting to get the joke. I still don't think they realize the extent of the gaming of the system that's been done by the 1% or the financially savvy. I don't think they understand it because it's complicated, and it's just complicated enough that it suits everybody, right? It suits the Fed for it to be this complicated. It suits Wall Street for it to be this complicated. But anybody who doesn't really have a financial bent necessarily, or a financial education that I've spoken to or subscribed to my letter and I've emailed with them backwards and forwards, once they start understanding what's going on, it's amazing, how greedy they get for information to understand it more, and it's amazing how quickly they get extremely upset about it. But you have to understand it before you can get upset. And I think that's what's going on in the broader society is people are angry and upset and confused, but they don't really know why. And so when the George Floyd protests come along, it's a channeling. It's a way to channel that frustration, that anger, that you're just not getting ahead. This is my kids are going to be the first generation that didn't do better than their parents for 100 odd years, which is really, really sad. And Gen Z are going to be probably in the same sort of boat unless we have that clearing event, which the system needs. So, Erik, I don't know when. I don't know what the end game looks like, but reading things like The Fourth Turning and understanding how these things have looked in history, at least you get clues. At least you know what to look for. And I gave a presentation a couple of years ago called Cry Wolf. And I talked about the ingredients that you needed for a reset of the monetary system. And, they were basically social unrest, political unrest, and financial unrest. And even back then in 2018, I was saying that we have political unrest and we have social unrest. It wasn't anywhere near as pronounced as it has been now. But what we didn't have then was financial unrest. We've seen the beginnings of that, and we've also seen how aggressively they've tried to prevent that financial unrest spreading, because that's the last missing ingredient before the system blows up. So you can bet your bottom dollar, whether it's printed or earned, that they are going to do everything they can to keep the financial system together. That will involve liquidity. It will involve potentially sending these markets even higher. But the higher they go, the more disastrous the crash is ultimately going to be, unfortunately.
All right, Grant, it's Patrick here. I wanted to stay on this theme of the recession and the economy, because you were touching on it here. And traditionally, business cycles would normally turn because of tight monetary policy, excess credit, tight labor markets, and it would just turn, and there would become a recession. It takes a while for the governments and central banks to realize it turns, and then eventually they respond. And so usually a drawn-on thing. So you hear all the people saying typical recessions last 6 months or 18 months. And yet here we had a induced recession, driven, of course, by COVID, which, while putting people's health ahead of the economy, was an important thing to do. But this created this monstrous economic drop to happen all at once. And suddenly, when you have such a huge shock, the rate of change immediately shifts, and everything seems so much better than it was when everything was just shut off. And the stock market and everything just responded with so much energy off of, like, from a reflexive way from that crash on the downside. But a lot of these questions haven't been solved in terms of which businesses will survive after the post-COVID world, and how many of these job losses are permanent, and how will that world of travel, how will consumers consume? All of these things we're still many months from having a clear picture on this. How do you reconcile in your head how this recession has played out versus past? And what's your thinking of how long this lasts?
I've tried to boil it down in the simplest way I can, and that is because you're right, that the rate of change is what's important here. And yes, things are bouncing back, but we're still nowhere near the economic activity we were at before this started. We are going to lose an awful lot of jobs, in the millions, maybe in the tens of millions. We are going to lose an incredible amount of economic activity. So the simplest way I think to boil it down and say, okay, are we going to be where we were before this started? Because at least we had a benchmark then. We knew what the fully functioning economy was doing. It wasn't strong, no matter what the president says. The US economy was not strong prior to COVID. But if we can get back there, then we have a baseline. And I would argue that the data I'm seeing, all of them suggest there's no way we're going to be back there anytime soon. So you have to, whether it's a V shape or a U shape or a K shape or whatever letter you want to conjure up, it's going to be lower. And that obviously has ramifications. You're going to have less economic activity. You're going to have weaker growth. You're going to have more unemployment. You're going to have weaker consumer spending. And just on a really simple back-of-the-envelope calculus, you can look at an economy that's 70% consumer spending and has seen 40 million people put out of work, even if it is temporary. Patterns are going to change. We've seen the savings rate go up to 30%. It's coming down a little bit. We've seen personal income have its biggest month-on-month increase in history because of all the stimulus checks going out. But we've also at the same time seen consumer spending have the biggest drop in history because no one's going out and spending money. So we know that the stimulus is either going to have to stop because they can't afford to pay for it anymore, because they're going to have now a $3.7 trillion deficit this year when they were budgeting for one, or they're going to go out and say, well, down the torpedoes, we're going to, if we have to have a $6 trillion deficit, we'll do that. Now, that would be born, I suspect, of hubris largely, assuming that the dollar was bulletproof and the US economy could withstand that and the currency could withstand that. I don't know if that's true. I suspect it's not, but we'll find out in the fullness of time. But we can't get back there again. And so if you've sidelined 40 million workers who are part of 70% of your economy, you've got some real problems here. And so what I think has happened, and people kind of have gotten so used to equating the stock market with the economy, which is so wrong. I mean, the stock market is supposed to be a reflection of the economy. And right now we're in this bizarre situation where people are seeing a reflection of the stock market in the economy. And it's just wrong. That's just not the way it works. And so if you listen to conference calls, you look at how many companies are pulling guidance, are lowering guidance, are failing to meet guidance, the economy is in a really bad situation. And it's not just the US. The UK is having similar problems. All over Europe's the same thing. Into Asia. I mean, the numbers coming out are, fortunately, in a bizarre way, so apocalyptic that people don't have a frame of reference for them. And we've had this, this law of large numbers as applied when we've got into the trillions and trillions of dollars here and trillions of dollars there. It doesn't, people are inured to it now. It doesn't mean what it used to. So when you see these outlying charts, like we saw of, jobless claims and continuing claims, when they first came through, and you took the charts all the way back to the 1960s just so you could see how far off the charts this latest print was, it looked like such an outlier to people that they tended to just disregard it. And obviously since then, at the margin, things have gotten optically a little bit better because, as you said, Patrick, quite rightly, the rate of change is not what it was. But if the economy is 20% below where it was prior to COVID, then a lot of these companies have to adjust their business accordingly. And you're just not seeing that with the prices in the equity market. So the sooner people realize that the stock market is a reflection of the economy, not the other way around, the sooner reality will return. But of course, there are a lot of people heavily incentivized to make sure that realization takes as long as possible to dawn on people.
Grant, I just want to ask you to elaborate a little more. When you say the stock market is the reflection of the economy, is it really, or is the stock market a reflection of expectations about liquidity, which might be influenced more by central bank policy than by economic reality?
Yeah, I mean, you're right. I could have phrased it better. I meant the optical improvement in the economy. But you're right. What it comes down to is liquidity. And what it comes down to is this, this mythical Fed put that we've been agonizing over since 1987 now. Seems a lifetime ago, and it is for many people. But yeah, the stock market has become a reflection of the measures being used, if that's a better way to put it. And one of the measures is obviously touting the apparently strong data. The only guy I've seen who's really picking this stuff apart and calling it for what it is Rosie, David Rosenberg. I mean, he's been consistent. He's been razor sharp, as he always is. And whenever I see these jobless numbers or, consumer spending numbers, whenever numbers come out, it's fascinating to me to see how invested in this the media is and the type of headlines that get written about these numbers. They really are towing the line. There's no coverage that is anything but, jobs have highest surge on record, personal income has highest surge on record. There's no context given. And it's down to people like Rosie to pick it apart and give you the real information and put it in perspective with days gone past and let you understand how dire the situation is. And of course, the number of people who read the headlines on CNN and USA Today dwarfs the number of people that follow Rosie's Twitter feed, sadly. And so this is, I think we talked about this last time, Eric, there's a real situation here where the good headlines are given an awful lot of coverage. And then the analysis happens a few days later, and it's just not given the airtime that the good headlines are. People have moved on. So you've got everybody reading what a great jobless number we had. And then a few days later, you get a few wonks in the finance world that read analysis on it and understand that, well, actually, in context, this is appalling. This is actually not a good number at all. But there's only the wonks like you and me that are reading this stuff, right? The three of us read that and go, this is crazy. But the masses have moved on to Kanye West running for president. And so it doesn't really matter anymore to them.
Well, before we hog it to ourselves, we should share with our listeners that David Rosenberg's Twitter handle is @EconGuyRosie, EconGuyRosie.
Now, Grant, what I wanted to stay on this conversation of these animal spirits and investors that have really taken over. I mean, after decades of being indoctrinated in buying dips, when this COVID hit, obviously stock markets were down 35%, but many individual names in the sectors most hurt were down 80+%. And instinctually, when you think back to all the people that say back in 2008, if I only bought, Citi when it was under $5, or all these different stocks that were these great opportunities, they saw these stocks selling, and suddenly as the market reversed, the FOMO kicks in, and it's everyone just succumbs to the animal spirits and needs to have a piece of the action. But now we're seeing the breadth disappearing, and it's fewer and fewer stocks that are driving these mega cap stocks driving this trend. How do you size up this situation? I mean, obviously you recognize that as a bubble, but this is probably your third rodeo in terms of these kind of bear market drops and these rallies. Like, how do you interpret all of this?
Yeah, I think you put it very well, Patrick. I mean, that's exactly what's happening, and the breadth is deteriorating. I mean, the market internals are getting very poor. But what happens is these bubbles don't pop until they've sucked in, the last marginal bit of money that was just sitting there waiting it out. I mean, if you think back to 2000, Stan Druckenmiller was the marginal guy, right? He got sucked in to the tech bubble at the very end, and lost $1 billion of Soros's money, right? And he talks about that. And when Ken Langone asked him what lesson he learned from that, he said, "I didn't learn anything. I knew I shouldn't have done it." And it's that. If Stan Druckenmiller can get FOMO and be pulled into a market that he knows he shouldn't be buying, then what we're seeing now with the Robin Hooders and the day traders and the people sitting at home betting their stimulus checks on stocks, it's a sign that we're near the top. But I haven't seen the level of capitulation from the bears yet. I've seen at the margin a few people, like Jim Bianco, who I have a tremendous amount of respect for. I think he's a fantastic analyst. He put a piece out recently saying, I've changed my mind. I think the market's going to go up. I mean, he was intellectually honest. He said, I don't think it should, but I think it's going to. That was a sign for me. I made note of that someone as data-driven and as experienced as Jim can take that view. And he's been right, and he could be right for a bit longer. But it's that kind of thing you have to look for. You have to look for the Jim Biancos of the world saying, I throw the challenge, I think the market's going up. Because at this point, realistically, the only way you can talk about the market going up is just because it's going up, or it's a liquidity thing, or it's nothing to do with fundamentals. It's pure adrenaline that's taking the market higher. And when that adrenaline leaves the bloodstream, I think any of us that have had a fright knows what that come down feels like. And I look at this, and as you said, Patrick, this isn't my first one of these, but every now and again we get a day where I look at it and it just feels wrong. And there's been a few more of those. The market action has started to get a little wobbly to me. And so I personally, I'm on red alert for a turn back down. But look, I mean, that's not to say it's definitely going to happen. We could go higher still before then.
Grant, I'd like to challenge you on that. And I can't believe I'm saying this because I want so badly to agree with you. This is, it's so overdue for this market to top.
It's not fun if we both agree about everything, Erik.
Yeah, I know. Well, here's the thing. I hate to say this time might be different, but here's the reason I think it might be. What you're describing is the mechanism for how bubbles have always ended in the past, which is you got to suck in the last of the FOMO suckers to sort of be the last guy to put his money on the table. Then there's no more money left because the last one of those guys got sucked into that market. There's no marginal buyer to be the next guy to come and buy. That's where the market tops. The whole thing falls apart and it goes into reverse. I get it, but here's why I think it's different. What's driving this bubble is central bank balance sheet expansion. And that next dollar is not necessarily the Robin Hooder. It's potentially an institutional investor who just sold all of their treasury position to the Fed because the Fed's expanding its balance sheet. They've got new cash that they've got to put to work someplace. And they're in that same position that Stan Druckenmiller is in, which is they're smart institutional guys. They know better, but from a career risk standpoint, they can afford to go down with the herd. They can't afford to go down by themselves. They're going to continue to invest in the market because they know it's a defensible choice that's not going to get them fired later. So that's what they do. And they keep driving it higher because there's more and more central bank liquidity supplying this, what already is gone on way too long. Why would it change?
Well, first of all, listen, I love the fact that you're challenging me with this time may be different. I mean, come on, Erik, you can do better than that. We both know better than that. No, look, look, it's a good point, but I would answer it. I would answer it like this. I think what the danger is to push back on that is that when we start getting results from these companies, when the economy fails to pick up and we start getting companies laying off, we see the permanently unemployed numbers go up and stay elevated, and people's businesses being affected, and basically all this stimulus wearing off. They may have to come with it again, but you've still got to get people out. You can't print jobs. You can't print consumer spending. And, anecdotally, I was in a socially distanced line at a coffee shop the other day and overheard a guy talking to, I guess it was his son or his son-in-law or something in front of me. And he was saying that, me and your mother's, we were spending $6,200 a month before this. We're spending about $1,200 a month now. He said, there's no way we're going back to where we were. We've realized that we were spending way too much. We don't need to spend that money. And it's just one tiny anecdote, and it's one guy. He could be a lone wolf. I doubt it. But that mindset is, if that takes hold, is a problem. And so when real businesses and the real economy start to reflect the damage that this thing has done, the liquidity doesn't matter, because what you may still have the FOMO crowd wanting to get involved, Erik, but what you are going to see at the margin are more and more experienced investors who hold a lot of stock, and either in a fiduciary basis or for their own account, and they are going to be selling because they're going to realize what damage has been done to the company's prospects, whether it's on a conference call or it's earnings guidance or whatever it may be. So for a while, you have maybe the Fed soaking up the bid, and maybe the Fed do buy equities. I don't know. They need some kind of law change to do it, but that will be a piece of cake for them. But they're going to be soaking up a lot more equity from major sellers, right, who are suddenly left holding stocks who've just come out and said, our business is going to be cut in half next year. We're going to make X amount of layoffs. You need to plan accordingly. And they look at these things trading on infinite PEs and, ridiculous price to book ratios, whatever their favorite metric may be. And they're going to realize we need to get out of this, and we need to get out of it now while there's a buyer. And it doesn't matter if that buyer's the Fed. So either the Fed has to stand behind the whole market if this economic damage is as serious as it looks, or this thing doesn't work. It may work in the short term, but it's the Wile E. Coyote going off a cliff, to use a hackneyed cliche. The legs spin in the air while the Fed picks up all the stock, but ultimately either the Fed nationalizes the stock market, in which case I suspect the dollar would get a kick in the teeth, or they run out of bullets, and the damage they do. I can't remember what it was, but someone was talking yesterday about the fact that the Fed actually will never run out of bullets because they own the bullet factory, and he's absolutely right. But the problem is that at a point, the more money you print, the more damage you do by doing it, because you make a laughing stock of your currency. So could this time be different? Of course it could. Is it ever different? No, it isn't. And I suspect that the economy will once again be forced to be reflected in equity prices. And if savvy market participants understand how weak these companies' businesses are, they will be forced to sell them as fiduciaries, and that's what I suspect will happen.
Folks, we're halfway through this great interview with Grant Williams. We'll be back right after the sponsor message.
This episode of MacroVoices was made possible by TopTradersUnplugged.com. In recent weeks, we've been reminded of the fragility of world financial markets and how quickly sentiment can shift from risk on to risk off. Once again, the mantra of buy the dip and the determination of central banks will be put to the test. But as Chris Cole recently told us, the best approach to investing in the long run is very different from what's worked best in recent decades. To help MacroVoices listeners navigate an uncertain future, Niels Kastrup-Larsen, host of the Top Traders Unplugged podcast, has created a guide to the best investment books of all time. You can get a free copy at toptradersunplugged.com/macro guide. And be sure to listen to my full-length interview with Niels Kastrup-Larsen on trend following. The download link is in your Research Roundup email. Check out toptradersunplugged.com today. You'll be glad you did.
Now, back to your hosts, Erik Townsend and Patrick Ceresna.
All right, Grant, it's Patrick here again, and I wanted to move on to gold because, I was thinking back that it was over 4 years ago when I saw the video you put out on YouTube called Nobody Cares. And your timing could not have possibly been better because it was like January of 2016 where gold was somewhere under $1,100 an ounce. And you make this thesis, and since then, gold has entered what is clearly, at this stage, a new bull market. Only needs to clear higher highs to really solidify it. But a part of your theme in that video was this idea of asking the question, what if? And what if these pension funds started allocating more money, that you were talking some sliver of a minuscule of money that they've allocated to gold. And as all this inflation fears and money printing comes in, what if they start allocating more money to that? And you were bang on. But the question I have for you is, well, now that we're 3 years and 4 years into this movement, what inning is this? I mean, how much more of this is there to go? I mean, is the easy money already been made, or is it still ahead of us?
Oh, no, I don't think so. I think we're in the very early innings in this next gold bull market. I really do. And there will be plenty of people listening. Go, oh, here he goes again. He's the perma bull on gold. I had this conversation on Twitter with someone recently. There was a time in my life, my career, where I didn't own any gold, I didn't care about any gold. And someone said to me on Twitter, oh, you've been bullish about gold for 5 years. And I said, no, I've been bullish on gold for 20 years. But that's not the point. And when there's a time to not be bullish on it, I won't be. But right now, I don't think there's been a better time to be bullish on gold than there is right now because of everything that's happening. And what gets thrown back at you as well, if they've done all this and gold hasn't even cleared its 2011 high, that's bad, right? And I don't know what to say to those people. For me, if you just look around at what's happening and you look at what gold represents, which is purchasing power essentially. You can look at it as insurance against the system collapsing, whatever you want. But at the end of the day, what it's always done is protect your purchasing power. And so everything that's happening right now is leading to further destruction of purchasing power of fiat currency, whichever currency you want to look at. So anyone that doesn't own gold, and I tweeted this out the other day, I said, if you don't own gold, you really should own some. If you own some, you probably don't own enough. Because at the margin, the point of that presentation, you said, and it's on YouTube if people want to go and look at it. If you just Google my name and Nobody Cares, you'll find it. But the point of that presentation, I gave it first at a precious metals conference. And I was saying to the crowd, look, we all get it because we all focus on precious metals. But outside this room, nobody cares. It's not something, some people punt the price and some people look at the charts and think they can make some money buying gold and selling gold for a small profit or shorting it and buying it back. But owning gold is a whole different mindset to get into, and the conditions weren't really right. And so it really wasn't until people outside that room started to care about gold that we would see some fireworks. And that's happening now. You can see it. I mean, the questions I get from people, the conversations I've had, the phone calls, the emails from people who want to understand gold suddenly have increased, multiple fold over the last year, but definitely over the last 6 months aggressively. And that's that moment when nobody cares turns to some people care. And the gold market is so small that that's all it takes. That was my point back then, is that if just at the margin more people tend to care, and whether it's individual investors or, more importantly, if it's institutions, if it's pension funds who start to allocate money to gold, and they have in the past and they will again, it really doesn't take much interest from those kinds of players to create all sorts of problems in a supply-constrained market. And that's where we are. I gave another presentation last year, and I talk about gold as a concept a lot because it's something I said that I think has been an important thing to own for a number of years. But I really don't get into talking about the price because I don't own gold for the price. So every time someone says, well, is it going to go above 2,000? I said, yes, I suspect it will. When? I have no idea. But I'm not hanging on that 2,000 price when to sell mine. I'm owning gold because at some point in the future, I suspect that the gold I own now, I'll be able to exchange for something that I want more at that particular point in time. It won't be a function of the gold price. And the way to think about this is if you look at a chart of the S&P 500 and you plot it against the S&P 500 measured in gold ounces, what you find is amazing. I mean, the 2000 and 2008 bubbles on the chart now of the S&P look like tiny little speed bumps from where we've gone, and we have broken out to a ridiculous level. And yet in gold ounces, the S&P is where it was in September 1996. So you could basically, if you had your ounce of gold that you held in September 1996, you could buy the same number of units of the S&P 500 today as you could have done back then. And yeah, you'd have missed out on 2000, you'd have missed out in 2008, you'd have missed out on this run. But it doesn't matter. No, so few people actually sell at the top and buy at the bottom. You wouldn't have had any of the stress, and your purchasing power would be the same today as it was in September 1996. And so if you think about that going forward, if you think about what's happening in the world, the amount of money printing that's going on, the amount of fiscal stimulus, the deficits that are being blown everywhere, if you think about that purchasing power of gold in those terms, and you think about what it'll buy you today, and some people will want to measure it will buy me $1,800 today. Okay, fine. Think about how many more dollars are going to be produced. Think about what happens when you get, not even hyperinflation, but when you get aggressive inflation. How many more of those dollars do you think your gold ounce will buy you? And so I try and think of it that way. So I gave another presentation last year called Crikey. And again, you can find it. In fact, both these are on my website, ttmygh.com. If you go there, you'll find Crikey and Nobody Cares. And that was the only time since the end of 2015 or December 2015, when I first gave that Nobody Cares presentation, that I actually come out and said, look, I think now is the time to buy gold and gold mining stocks because the setup is probably better than it's been at any point since December 2015. Now, obviously, I had no idea COVID was going to come, and once again, I got lucky with the timing. But timing aside and COVID aside, if you look at what's happening in the world, the argument for owning gold is very, very clear. For me, what I want to hear is someone to explain to me why I shouldn't own gold and I shouldn't own a sizable allocation to gold. That's an argument that I would love someone to make to me, but I've yet to hear it credibly put.
Grant, I couldn't possibly agree with you more, and I've long said that gold will be the asset to own in the 2020s. I do credit you for being more outspoken and earlier than I was in making that call. But, I think something we both know as investors is you're not doing yourself any favor to sit around and talk to people you agree with about why you've already made the right decision. What we need to do is focus most of our energy on what could we have gotten wrong, what unexpected event is possible that could screw us up here, because I've got a large allocation to gold, as I know you do and many of our investors do. What are the things that might be the unexpected bumps in the road or the surprises that could make us, at least in a temporary time frame, wrong about gold?
Well, look, if we get positive real interest rates somehow, that's always a headwind for gold. That's never a good time to be long gold. That's definitely a concern, but it's hard to see how we get there. If we get some kind of fiscal probity, then I would certainly be worried. I don't see that on our horizon anytime soon. If we were to get the Fed saying, right, listen, this has gone way too far, we're going to have to take the pain here, and we are going to have to get our house in order, I would be worried about gold. All of these things could happen, Eric, but people can handicap them as they wish. I put a very low probability on all of them, particularly in an election year. The Fed will not want to be perceived as being political at this point. I think they're probably beyond that, but that's a question for another day. I struggle to see, and I agree with you. I completely agree that the search for the reason you're going to be wrong is always the most important search to make. But I think what's just as important is once you have a theory, just to keep retesting it, because there will be periods where you don't find anything that can challenge your idea. The danger is at that point, you just put your hands behind your head, sit back and wait for the fireworks to start. No, you have to keep checking. Right now, I struggle to find a negative for gold that I put any kind of high probability on occurring, but I'm going to keep checking every day. I'm going to keep looking at the world. I'm going to keep looking at what the central banks are doing. I'm going to keep looking at what governments are doing, and keep looking for that case that tells me it's time to take profits. I don't see it. And again, it's not something I trade. I've held my gold and I've just added to it over the years. The things that I will buy and sell in various points of time are the mining shares. but the gold is a core position for me, and I'm not in any hurry to exchange that. The miners are different, right? They're definitely, with those, you can see froth getting into them, you can see despair getting into them. I mean, they are great vehicles if you are brave enough to take the other side of both greed and fear. If you're brave enough to do that, there's arguably no better sector to play in than the gold mining, precious metals mining shares. But it's you're playing with lit fireworks when you do that, and it's not for the faint of heart, that's for sure.
I'd like to share my answer to that question and get your reaction to it, and particularly the conclusion I draw from it, because I've pondered this, Grant, and, I agree with you completely. I think that it's very hard to find a negative outcome for gold. I can certainly make a short-term downside volatility argument, which is we've come up so much so fast that there's got to be weak hands in the market. We haven't really had a substantive technical correction. When we get one, it's going to shake out weak hands. It's going to create some downside volatility that could get ugly in the short term. Frankly, I have to admit, I'm crossing my fingers waiting for that to happen, because I'd love to load up on more gold at a cheaper price. And I don't think that it would be sustained. I think in the long run, it's got to be a positive outcome for gold. And I remain convinced that gold is really the only clear, strong macro trade that you just have to believe in, not right now, but for the next decade. You look at what's going on with the debasement of fiat currency, and gold just has to be it as far as I'm concerned. Now, the conclusion I draw from that scares the hell out of me, which is, wait a minute, gold is never supposed to be the best investment. Because what is gold? Gold is what you trade into to run away from systemic risk when you don't believe in the power of capitalism to produce profits. When you say, you know what, I'd rather be in an asset that produces zero income, at least that is scarce enough that it will protect my purchasing power, even though I'm not going to make anything in terms of a nominal return. I'm so concerned about the future of the world that I think my real return is going to be positive because the rest of the world's going to shit. That's really the only way to interpret that bullish of an outlook on gold. And it really, to me, sends a very scary picture about where we could be headed if really smart guys don't see a better trade than gold on the table right now.
Well, there's a bunch of stuff in there that I'd answer, Eric, actually. It's very interesting. First of all, is there a downside volatility argument? Absolutely. But for me, I don't think about the price. I don't think, is it going to go from $1,800 to $1,600? I bought my first gold at $333 an ounce, and I've been accumulating ever since. So I'm not, if it goes down to, $1,500, that's not going to faze me. It won't bother me at all. I'll buy some more. But people have no problem in saying, I'm going to go to cash, right? That's not running away from the market. That's sitting on the sidelines. I've sold down my equities and I've got a 50% cash position right now. And yet it seems a very complicated line between the two dots of having a lot of cash and having a lot of gold. And there are plenty of people that I've met and talked to over the years, and I subscribe to this theory too, very, very smart investors who think of gold as their liquidity reserve. They think of it exactly the same as cash. But it can't be debased and it can't be printed out of thin air. And I think the thing about gold that's always fascinated me, and I kind of had the light bulb moment early on, is that it's a frame of mind. It's something that you either look at it one way or you don't. And if you look at it one way, if you look at it as I do, as a reserve asset, as a store of liquidity, as a store of value, as a protector of your purchasing power, and you start to value other things in gold, you get a very different perspective than if you look at gold as a trade, as you mentioned it back there, or a speculation, or a commodity. I mean, it's none of those things to me. Now, there are plenty of people who have made a career being traders of gold, and they will buy it when they think it's going up, and they'll sell it when they think it's going down, and they'll look at the commitment of traders reports, and they'll take the other side of that, and they'll do all this, which is great. But they're not. If you substituted gold for copper or nickel or soybeans or anything, they would have the same approach to it. It's nothing to do with gold, and gold gets lumped in with commodities, and it isn't. JP Morgan said it best: gold is money, everything else is credit. And so, for me, it's always required a certain mindset to think about gold in a way that clears up a lot of the misconceptions about it. And I had that light bulb moment early on. I've known plenty of people who've had it since, but I've known plenty of people who just don't get it, and they've never been able to look at it that way. But what I've never seen is someone who has had that light bulb moment with gold, who's looked at it in that slightly different way and turned the world on its head and looked at things through the lens of gold rather than looking at gold as part of the financial system. They've looked at it as the bottom of the financial system. I've yet to meet anyone that's had that realization who has gone back the other way. I think once you see things that way, it changes. It changes your outlook. It changes your worldview. It changes how you move the chess pieces around the financial chessboard, because suddenly you realize that gold is your king. It's not a pawn. It's not something that you can be traded away. It's the thing you have to protect. And so I'm always interested. And there are plenty of people who just don't see it this way, and that's fine. I mean, I've spent more hours than I can count talking about this stuff with people, and I've enjoyed every conversation. I've enjoyed conversations with fellow advocates of gold, and I've enjoyed conversations with people that think it's a useless pet rock. But it's very interesting that as I say, that view of gold, looking at gold first and then seeing how the financial universe orbits around it, as opposed to seeing it as just something in the system that is fluid, changes a lot of people's thinking on this. It certainly changed mine.
Grant, I'd like to move on to a topic near and dear to both of our hearts. I know you used to be a Hong Kong resident. I still maintain legal residency in Hong Kong, although I don't spend as much time there as I used to. Boy, changing political climate, and it looks to me like it's about to get worse. What do you make of the situation that's going on with Hong Kong seemingly losing its one country, two systems status that was guaranteed through 2047 by treaty? Looks like it's not going to be honored. What do you make of all this? Where do you think it's headed, and what does it mean for the rest of the world?
Well, look, first of all, to me, it's a great tragedy. I love Hong Kong. It's such a place in my heart. I spent almost 4 very happy years. I've been going there since the 1980s, and it's an incredible place filled with amazing people. I've got a lot of friends there. And so for me, it's incredibly sad to see what's happened. I mean, yes, I think you're right. We've seen the end of the one country, two systems, and I think this is probably way more important than the coverage it's getting. We had the riots last year, which were front page for a while, just like the Gilets jaunes protests were in France. And you and I spoke about this in January, Erik. And then people get bored with the same old pictures of Molotov cocktails and riot police night after night. And so these things tend to move out of the news cycle, which is a great shame, because when you look at Hong Kong, this is a fight for the future of a democracy, and it's a fight that currently democracy is losing, and it's really hard to see how democracy wins this fight. What I've been incredibly encouraged, I have to say, is looking at the response from the British government, who've offered a path to citizenship for 3 million Hong Kongs who are British overseas nationals, which is a very stand-up thing for the British government to do. Obviously you've seen Taiwan offer refuge to them, but that's more of a political statement and kind of poking the sleeping giant. But other countries have done the same things. There definitely seems to have been a unified response to this from democratic countries around the world in terms of trying to send a message to China that what they're doing, I mean, it's hard to say it won't be tolerated, because realistically speaking, what can people do? The US response has been lackluster, I have to say. I've been disappointed in that, but then they've obviously got a trade deal to try and get ratified, and we're in an election year. So, it's interesting to me that having made China such a bugbear throughout the last 2-3 years, as Trump has, that we've seen very, very little out of the US in terms of this. Because if they wanted to go after China, they've just been handed the stick with which they can beat China with, and they, for some reason, picking it up the way the Brits have done and the way other countries have done, which is disappointing. Even Australia, for whom China is by far their largest trading partner and by far the most important global relationship the Aussies have in terms of their economy, even the Aussies have come out and said that they will take steps to ensure that basically Hong Kong citizens have a place of refuge there. So the response from the US has been disappointing and interesting. There's obviously more behind it, and there are conversations going on, I'm sure. But that has to be seen within the context of something, again, I wrote about a few weeks ago in a piece I called the Leung Telegram. And that is a piece published on the White House website laying out a new strategic plan for American relations with China, which is essentially a declaration of a Cold War. And it's a remarkable document that people should read. And I'll put it up on Twitter after this so people can get a link to it and read it. But the battle lines have been drawn. And so when we began this conversation talking about conflict within a given society, and we didn't get any further than that, but when you go outside that and you branch out, you can clearly see a multipolar world shaping up here where people are going to be required to pick a side, and there are going to be some schisms in the global framework. There is no doubt about that. They're happening already, and I think Hong Kong is the thin end of a very, very dangerous wedge. And so I'm disappointed in the amount of coverage it's getting. I'm disappointed in the seeming lack of understanding of how important it is, and I hope that people become more aware of it, and we start seeing a little bit more activism on the part of the US, because if anyone has to lead that response, it really has to be the US.
Grant, we should probably mention, for the benefit of any listeners who are not following this story as closely as you and I are, the situation really is very concerning to me. What's happened is most countries around the world have very strongly criticized China for its actions in not respecting the treaty with Hong Kong. The primary thing that the United States government has done has been to say, we're very, very outraged that China is doing this. Therefore, we are going to suspend the policies that gave Hong Kong special treatment and treated it differently from China. And it's like, to anyone who's living in Hong Kong or who understands this situation, it's, wait a minute, stop. So what you're saying is China has been completely unreasonable in mistreating Hong Kong, and the solution to that is for the United States to punish Hong Kong by suspending all of the special treatment that Hong Kong used to get and taking that away. Whose side is the U.S. on? Do you see it that way, Grant? And what do you think the U.S. should be doing instead of this policy of what I see as punishing Hong Kong for the fact that they've been punished by China?
Yeah, it is a tricky one, right? I mean, I think what's the motive behind that move is to try and squeeze China's access to capital markets. I'm sure that's what it is, and to stop money flow out of China through Hong Kong. That's what they're trying to do. They're trying to squeeze the party. They're trying to squeeze, again, the haves, right? Because the split between the haves and have-nots in China makes that in the Western world look, positively non-existent. So, I mean, I'm sure that's what the Americans are trying to do, but don't forget, they're also juggling with the fact that they are trying to get this trade deal done. And unfortunately for him, Trump has, Trump and Kudlow and Mnuchin have really tied themselves to this trade deal. And so they have to get this thing done. I mean, they've kind of lost the whip hand there. So that if they alienate China to the point where the Chinese walk away from the table, that's a real problem for the U.S. administration now. I mean, that's not to say it would be in China's interest to do so, but if you push them too far, don't forget that the thing that is most important to China is control. And so if it looks as though you're going to be beaten with the Hong Kong stick, you have to get that under control as the Chinese. They can't have another Tiananmen Square on their hands. And I suspect they would walk away from a trade deal knowing full well that should they, in a few months, when things have died down, want to walk back to the table before the election, the Trump administration would be really forced to engage with them. So I think the Trump administration are very aware of this, and they are trying to make as much noise as they can, try and say to the party members, look, we can hurt you here. Let's not let this get out of hand, but without taking the nuclear option, which is to call off the trade deals and sanctions and all that kind of stuff, which you would have thought they would have done. But as I said, election year trade deal, I don't think that's going to happen anytime soon, unfortunately.
All right, Grant, I wanted to move on to Europe. And, after almost a decade-long purgatory, both in their stock markets and economy, from all the austerity, financial repression, all the negative interest rates, suddenly we have Christine Lagarde coming in, and they're moving toward more fiscal. Is this a turning point in your mind in Europe? Is this finally over? Is this finally that period where Europe is going to start seeing real, legitimate change in their economy?
Look, it's a great question, Patrick, and I don't know the answer. I mean, my stock answer to such a question would be, look, Europe's not over until it's over, right? Until the whole thing fractures. Maybe they have a period here where they all come together in times of adversity, and the Germans understand that they do have to do the heavy lifting. God knows they've certainly juiced their own economy through COVID. So maybe this gives them the cover they need to maybe loosen the purse strings for the rest of the continent. But the trouble is with Europe, let's say they do turn it around there, and they do find a way to stimulate the economy, and they can all get on the same page. The rifts across that continent are so deep, and there are so many of them, that it's just a matter of time until we get some kind of recovery, and the Germans want to tighten the purse strings again, and the Italians and the Spanish say no chance, or the French or the Greeks, or it's fundamentally the case that without that fiscal union, the EU doesn't work. It was never going to work. And like a lot of things, the fact that it did work when times were good, and when the rate spread was compressing between the Northern Bloc and the Southern Bloc in the early days, and everyone could borrow, and that was great. So the fact that prior to the launch of the euro, Margaret Thatcher's last speech to Parliament, she explained exactly what was going to happen with Europe, exactly the flaws that it had because of its construction. And of course, everything she said ended up happening. But it didn't really happen for I guess 10, 12 years, really, post the introduction of the euro. And so people kind of have this idea that it does work, and this is just a period of time. The simple truth is it never worked. It was never going to work, but they had that tailwind behind them in the first decade of the project. And now, in times of austerity since 2008, we've seen this thing for what it is. We've seen where the fractures lie, and we've seen just how impossible it is for this thing to go ahead unless they can find a way to achieve fiscal union. Now, that's the golden bullet. If you tell me they're going to come up with some kind of fiscal union, euro bonds that everybody signs on to, and the Germans are happy to do it and, backing it vociferously, then things change materially for Europe, and they change for the euro, and all sorts of things change. But until that happens, again, as the baddie in the Bond movie said, they're a kite dancing in a hurricane. And I think it may be they look relatively okay for a short time now, but longer term, unless they can get that fiscal union, I don't see how anything changes.
Grant, Angela Merkel recently said that the rest of the world should get ready for a trend change where the U.S. stops being the hegemonic superpower of the world, and that power starts to fade. What do you make of that? Is that an important trend, and what should we conclude in terms of markets and investments?
I thought that was a fascinating thing that she said, Erik, I have to say. Really remarkable from a political standpoint. And you could look, we know that her saying that was not an off-the-cuff comment. That was something she thought very carefully about saying. And so you have to think about what were her aims in saying that. One is, well, we can tell that the US is in decline. So maybe there's a chance here, if this is going to be a multipolar world, for Europe to throw its hat in the ring, and maybe we take over, and us and the Chinese run the world together. Is it an attempt to sway the election? Is it a way to get Trump out of office? Potentially. It's hard to say. Is it a means of a kind of backdoor shoring up of Europe? Because Europe, with Brexit and everything else, with the Italians, the problems with the Italians and the French, and is it a way of trying to give everyone in Europe a little bit more pride, a little bit more prestige? I don't know. There are an awful number of reasons you could attribute to her saying that. I think what's important is that she did say it, and she said out loud what many people have been saying behind closed doors for a long time. And it's one of those things that it's, until someone like Merkel gives that kind of statement oxygen, it's kind of a fringe thing. But when you hear the leader I mean, let's face it, the de facto leader of the EU talking in terms like that, that's a game changer. It just remains to be seen what it means. I suspect it will become evident what that statement meant. It won't be something that gets said in isolation and lives in a vacuum. There will be other things behind it that we need to be paying attention to, because I can guarantee that is, again, the thin end of another wedge that is only going to broaden out as we move forward.
Let's move on now to our final topic, which is the U.S. election. Grant, it feels to me like a lot of things are lining up to kind of come to a head around election time. You've got all of the Black Lives Matter and the civil unrest and so forth going on. Feels to me like the timing is about right for maybe a crescendo in the COVID-19 crisis to occur around the time of the election. And it also feels to me, frankly, like a lot of people are intentionally organizing their affairs, whether it be the Black Lives Matter and so forth, to influence the election. Meanwhile, most of the experts that I've read have said there's really no reason to expect the outcome which everybody takes for granted, which is you find out on election night, November 3rd before midnight, you know who won. And what I'm reading is, why would we expect that when we know there's going to be a huge number of mail-in ballots? It's expected to be a close election unless it's a complete sweep. We're going to have a situation which, number one, nobody's really sure what the outcome is for several days after Election Day. And number two, it's very likely to be contested by whichever side doesn't win. And number three, it's almost a certainty that half of the country is pissed off by the outcome no matter what happens. How do you see all of this, and what should we prepare for?
Well, it doesn't sound good, does it, when you put it like that? I think you're absolutely right. I think you're absolutely right. I think the one thing that feels common to both sides is this anger that we're feeling. Both sides are angry, but also both sides want change. Even the Republican side want change. They want the left to change, right? They want so-called radical left to be kind of put back in their box. And so you've got 300 plus million people who want change. And so you're either going to get change, which is going to be the kind of change that half the population don't want, i.e., the Democrats are going to win. You're going to have a change of party in the White House, or you're going to get no change in the White House, which is going to make a lot of people angry. And as I say, the popular vote suggests that there are probably more Democrats than Republicans in America in terms of the voting public. So I do fear for this election. I don't think there's a good outcome for this election. That's what worries me. Unless, as you say, we get a clear sweep. If we get a clear Democrat sweep, then it's probably less divisive, I would think. I suspect if it's a clear sweep, Trump will have an awful lot of trouble spinning it and agitating. If it's a clear Republican sweep, then I think the Democrat Party will go into meltdown mode. I mean, they will go on full tilt, and that could mean a lurch further left. You know, having batted off Sanders 4 years ago and batted him off again this time, I suspect it'll be time for the Democrats to go full left, which won't be good looking down the road. So whichever way I look at this election, I think the one outcome that I feel very confident in predicting is volatility. I think around the election, we're going to see tremendous volatility. I think the polls are going to be important. Everyone's going to be looking at the polls. They know what happened last time when Trump came out of nowhere. So I think things will get very volatile around November time, and people should be planning accordingly for that with their portfolios, because political volatility in times like these is the last thing you need, and it could really put the cat amongst the pigeons.
Well, Grant, we knew when we decided to run a double-length feature interview for this week's holiday special show that there were very few people in the world of finance who could actually carry a full double-length interview. And ironically, I find myself running out of time, wishing that we had more time to go into even more detail with you. For people who do want more detail from you, you're one of the most prolific people in the industry, probably best known for your newsletter, Things That Make You Go, But you've also introduced this series. Almost feels like maybe there's a new venture underway. What's going on? What's next for Grant Williams, and where can people who want to follow your work find out more about what you're up to?
Yeah, well, thank you. The easiest way for right now is to go to, as I said, ttmygh.com. The Humanars, I mean, I've done a bunch of podcasts. I've been sat at home, like you, Erik, locked down in the Cayman Islands and really nowhere to go. I mean, not allowed out on alternate days and stuff. So it's been kind of thumb twiddling time. And I've got a lot of good friends around the world who I love talking to. And I figured, well, I'm probably going to talk to these people anyway. So let's start doing a few podcasts. So the Humanar series was just an attempt to do that and have some conversations and let people listen in. And then the podcast series, and you'll find those on Podbean and the iTunes Store and Spotify. I think it's under the Grant Williams podcast. But I've got 3 kind of streams under that podcast at the moment, each one with a different co-host. One of them with Ben Hunt, where we, on an ad hoc basis, talk about narrative and the things he sees in the market around narrative, which is always fascinating for me. Another one with Bill Fleckenstein called The End Game, where Bill's been talking about what the end game looks like for a long, long time. And so he and I have kind of taken it on ourselves to talk to people and try and figure out what the end game looks like and when we might get there and what the path to it might be. And then a third one with my dear friend Steph Pomboy, who I've managed to persuade to come out from under a rock where she prefers to hide and host a series of conversations with me with mutual friends of ours and investors that whose brains we want to pick. And I've got to say, they've all just been so much fun, and the feedback on them has been terrific. So I'm delighted.
Well, Grant, we can't thank you enough for joining us. And for all of our listeners, we're going to be back to our normal format starting next week. So thank you very much.
This episode was made possible by TopTradersUnplugged.com. Remember to get the ultimate guide to the best investing books ever written at TopTradersUnplugged.com/macro guide. For information on sponsoring Macro Voices, please visit macrovoices.com/sponsor info.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.